Um, Good evening, Yuan Tong, Kong Yup, Sam. Hope you guys are doing well. If you guys can hear me, Wendy, hi Lee, Poverson, hi, welcome, good evening. Now, if you guys can hear me well, if you can just say hello, or you can hear me well, you can just put in the comment section below. And we're gonna get started now. Tonight we actually have a very, very interesting topic, and I think that's really on a lot of people's minds tonight. Is really inflation. Markets. I think in the last week, both traditional markets and new markets, right, like crypto markets, have almost it almost seems like a meltdown, right? Anything in crypto moves 5 to 10 times faster than equities. But nonetheless, we have seen some drawbacks and we've seen some drawdowns on stocks. And you might be wondering, in this whole scenario, what's likely going to happen. So I'm going to share with you my personal thoughts and analysis of what I think may happen, right? Second thing is also potentially where are the areas where you can hedge your risk a little bit if you are in stocks, right? And of course, today is SGX Tuesday, so we will be covering some SGX listed companies here. All right. So I'm going to get kickstarted. Thank you very much, Yad Lao, right? It's nice and clear. Pover San, thank you, right? Okay, now, so I'm going to go into my slides right now. There we go. Okay, cool. Now, of course, quick disclaimer before we do continue. This is absolutely not financial advice, all right? This is my own research or our team research done by Equity Tracker, and we've come to some of these conclusions. So we're going to present the facts, and you will have to make that informed decision, all right? So this is not financial advice. Now, of course, look, I think it's kind of been around the headlines. Last year, the headlines were very different from this year. And I think this was almost, this whole inflation that we're seeing today is almost foreseeable last year, right? And I'll share you some of the factors, what has happened. So if you're not tuned in the news and you don't know why stocks are coming down and why the US dollar is strengthening against almost every single currency in the world today, right? If you're wondering why the ringgit has weakened, actually the US dollar actually has appreciated, right? So why are some of these factors hitting today? So one of the main reasons is that the Federal Reserve, Jerome Powell, has actually, as of last week, actually increased interest rates by 50 basis points, right? For normal human speak, right, 50 basis points means 0.5% interest rate. Now, for some of you, you're thinking, what's the big deal, right? Earlier this year in January, increased it by 0.25. So this year it's been 0.75 in a period of 5 months. So that is a very fast rate hike, right, in a very short period of time. So if you're wondering what's happening, if you look at this is the inflation rate, US inflation rate. So one of the textbook ways to actually combat inflation is to reduce money supply, reduce liquidity, and to increase interest rates. So what happens here very quickly, if you think of the economy as an aquarium, right, and the central bank decides how much water they want to put in or how much water they want to take out, right? So what happens is that when you increase interest rates, what happens is that you're actually trying to take money out from the system, right? Reduce liquidity effectively, right? That's what interest rates does. So we're going to look at some of the magnitude, right? So if you look at the actual interest rate, actual inflation rate, now we have to remember this. They calculated March versus March last year. And if you remember very clearly, last year in March, half of the world was pretty much still in a lockdown, right? We couldn't really get out of houses, or some of us could, some of us couldn't, depending which part of the world you're in. So prices in 2020 and 2021 were fairly depressed because not because there was no business, but because COVID hit, everyone had to stay home, right? So it's lack of business activity. So of course, when you compare a period of time where there's very, very little business activity, and then now all economies are opening up, you would very naturally expect inflation. Now it seems the press is saying that it's caught everyone by surprise that there was this massive inflation rate. But let's look at some of the factors and what are some of the key indicators you actually knew beforehand that this might happen, right? So if you look at the index, right, one of the largest contributor for the index in March 2021 versus March 2022 is fuel, right? I think all of us feel that, except in Malaysia, we're all very lucky lah. RON 95 still at 2.05, right? Actual price should be about $5 to $6 lah. So that contributed to the largest factor of the increase in inflation, right? Now, even if you take out oil from the CPI index or the inflation index, it's still fairly high because you got food, you got clothing, you got housing, and so on and so forth, right? So it still rose 6.5%, right? So it's still quite a large number. Now, we're seeing headlines almost daily, right? That now inflation is the key word that the press has decided that we're gonna distribute that as much as possible. Now, so that's UK, but if you look at Malaysia only 2.2%, right? Any guesses here why Malaysia we are the lowest inflation rate? Okay, give you guys a prize for those who can guess this correctly, all right, or who can answer this correctly. Why is US 8.5? UK is 7%. Malaysia April, right? In March actually only 2.2% only, right? Okay, true numbers, not fudge, true numbers, right? If anyone can tell me why it's 2.2%, I'd love to hear what you think. Even in Singapore, where interest rates are relatively fairly low most of the time, was actually 5.4% in the same period of time, right? Stephen Patrick, subsidized oil price, yeah, okay. Give me a deeper answer. Of course, yes, oil price is one of the factors. But if you look at the US, it's 8.5 minus, and minus oil price actually still 6.5%, right? The basket is different. Yeah, slightly different, but they're quite similar. Subsidies. Okay, Pang and Peter, all right? You guys came very close. It is because a lot of the baskets of goods, so we didn't change the basket of goods. It's very much a global standard, so you can't just change the index as and when you want to, right? So if you look at the index numbers inside there, a lot of the staples are price control items, right? So your sugar, your chicken, your poultry, your eggs, your generally most of your staple cooking oil and these kind of things are all very staple, right? So they're not in a way, yes, subsidized, but they're actually price controlled. So if you look at Malaysia's CPI, you're going to realize, 2.2%, that's very low, right? So it is artificially low. So the answer is yes, it is artificially low. Yes, and of course, one of the things, petrol price is also subsidized. So therefore, it remained 2.05 throughout this whole period. But it should be at least 2.5 to 3 times dearer than 2.05, right? Okay, so this is why. So of course, if we are allowed to free float a lot of these things, then I think that will be we'll probably get similar headlines to what we're seeing in the US. All right. So yeah, Zian. Well, we are net exporters, Zian. You're right, but not necessarily why the reason why our CPI specifically is not growing as fast as possible. So if you look at a very quick overview, you're going to see Malaysia 2.2%, right? So we seem like champions, and of course in March also 2.2%. Now, of course, we have to remember inflation rate. If you look at the CPI by itself, it is very much a how do I say? It is very much a something that it's not so fixed in price because they use average prices, right? So you can poke holes at CPI, but what we want to look at it is purely for the consistency of it, right? Now you're gonna find, for those of you who live in urban areas, in the US they do publish urban CPI versus non-urban CPI. So in the rural areas, generally your inflation is lower, all right? But let's just look at it as what it is, and we want to compare it now. Very importantly, we want to look at what has been causing inflation, and really, is it a surprise? Absolutely not. In fact, last year, when we did a coverage on this, we did highlight this, and you see sometimes inflation has a lag effect, where you get a lag effect. Now, so if you look at this now, one of the main causes, main causes, right? Now I'm going to show you guys two graphs in a short while, and you guys can take a look. Since January 2000, right, M2 actually shows you how much money supplied. That means you think of it like an aquarium, how much water in the tank, okay? How much water in the tank. So if you look at it, it was about 5 trillion or 4.6 trillion US dollars in the aquarium in year 2000, okay? Now you fast forward to 2020, that number has jumped about 3 times. So if you have water this much, it went up by 3 times how much water, right? Now remember, inflation very much, if you look at the definition of inflation, is more money chasing fewer goods and services. Now you guys have to remember this, more money chasing fewer goods and services. So the one of the key causes of inflation or runaway inflation is the excess printing of money, creation of money, right? And because you all know we are in a fiat currency system, which means that it's no longer backed by gold or anything now. So as governments want to, they will just create and print, right? So of course we've heard disastrous stories about Argentina. We've heard about Zimbabwe. These are all great economic case studies, right? But we look at the US and the world that we live in today. Now look at the number here, right? From January 2020, which is really just the beginning of COVID. And you look at the end, I think this was January 2021. If you look at this, that number grew to 21 trillion. So in a period of 1 year, right, they grew 6 trillion. They printed $6 trillion in 1 year, right? Now remember, it's not how much money you create, it's how much money you create over a period of time. So if you're creating almost 30% of whatever you have created before in 1 year period, I think 8.5% inflation rate is actually considered quite low, because you printed 30, actually close to 40-50% if you look at the end number, right? So now during this era, really to prop up the economy during COVID, what the government did was really what they call helicopter money. So what is helicopter money? Helicopter money is made famous by Ben Bernanke, right? Basically, you take a helicopter, throw money. So in the US, that's exactly what they did. They literally gave out prepaid Visa cards with $2,000 inside for you to spend, right? To keep the economy going, right? So that's really what they did. Now, of course, this has consequences, right? And of course, one of the consequences is inflation. So the inflation rate that we're seeing today absolutely should not be surprising. I also don't know why the Fed is surprised that, they need to increase interest rates, right? I think the market should have accepted this. Now, I'm going to give you a different context of printing of money around. The other way of looking at one is creation of money. The other way is actually the Federal Reserve balance sheet. That means every time they buy bonds from the market, they create more money, okay? They create more money. So I want to give you guys an idea here. Last night in our club session, we did cover some of these slides here. So for those of you who missed out, this maybe a very short repeat, because it was almost 2-hour session. This was like a 20-minute session. Now, if you look at since 2008, right, the word quantitative easing really was invented or created or made popular by Ben Bernanke. He was a Federal Reserve chairman back then. Now, if you look at this, back then in the 2008 financial crisis, for him to prop up the economy to make sure it doesn't go in a downward spiral, they created money, right? And it was huge amounts. Back then, it was considered huge amounts. So 2008, I can tell you, was really only 14 years ago, okay? Not really a long time ago, maybe max 15 years, right? If you look at this, and back in 2008, they grew the balance sheet from 0.9 trillion to 2.2 trillion in a period of about 18 months, right? So they actually 2 times the money supply, the federal balance sheet. They just buy, suck up, keep printing money. So when they buy, they're printing money and creating money. Now, what happened subsequently after that was actually QE never stopped, right? Despite where the economy was going. Now, it was only when there was a change in the Federal Reserve chairperson, which was Janet Yellen back then. If you can see, back in 2004, 2014 to 2018 here, she actually tried to reverse what Ben Bernanke did, right? Was creation of money. So you can see that she tried very, very hard to reduce liquidity, right? And you can notice in 2018, the economy started slowing down already, right? Even before COVID hit, the economy already started slowing down, because all she did was really move from 4.5 trillion and bring it down to 3.7 trillion, right? Now, if you look at it in absolute terms, that's only 800 billion. It's really, in the Federal Reserve, it's really not a lot, okay? 800 billion. And even then, it was a considerable slowdown. Now, what happened was, at the beginning of 2020, before COVID, your federal balance sheet was actually 4.1 trillion, right? In 2 years' time, it went from 4.1 trillion to 8.9 trillion. So you guys do the maths here, right? So you're actually printing 2.5 trillion dollars in 2 years. So they literally were doing $900 billion. They were doing something like 80 to 90 billion dollar bond buying every month, the Federal Reserve. So they just kept pump priming. They just kept increasing water in the aquarium, right? More and more water, right? Subsequently, now they're saying that, oh, look, we're so surprised there is inflation. I mean, obviously there's going to be inflation when you create so much money in a short period of time. Now, so what is making headlines right now is this. Everyone is now moving back to the US dollar because they're saying they're going to increase interest rate. Therefore, what are the consequences of this, right? The consequences of this is that generally all asset classes, and I talk about financial assets, you talk about stocks, you talk about real estate, what they're really trying to do is actually bring down inflation rate. But when you bring down inflation rate at this pace, you might actually trigger a recession, right? So Jerome Powell actually who is the current Federal Reserve Chairman, actually has a very, very tough job ahead for him, right? It's not easy. He print money, more inflation. He don't print money, slow down, recession, right? So it's actually a very fine balancing game. And I don't think it's really that easy to do it on such a macro level. Now, so, people ask me, so what do you think is going to happen? Now, the question is, do you think they will bring it down to 6 trillion? I mean, that's my question, right? Because they said they're going to very aggressively increase interest rates. And now, instead of doing quantitative easing, they're actually going to be doing quantitative tightening, right? So QE versus QT, right? Which is the exact reverse. That means instead of creating money, they're going to print money, right? Now, my guess is in a very short period of time, if they really bring it down to 6 trillion, that means, don't forget, we are still up 2 trillion in 2 years. Okay, so because we were 4.1 trillion before, it goes to 8.9, you bring it to 6 trillion. What do you think will happen if they actually bring money supply down to 6 trillion? We're actually now seeing some of the effects here, right? US dollar strengthening. So when US dollar strengthening, a lot of people want to buy more US dollars now, right? Because they perceive that it's going to be more valuable, right? So I'm going to give you guys an idea. And really, if you look at it, if they bring it down to 6 trillion, anyone want to guess what will likely happen? Right. My guess is that there will be a market explosion, right? You're going to get massive tanking in financial markets, and you will almost absolutely trigger a recession, right? So you see, the thing about liquidity is very important to understand, right? You can increase it very fast, and of course you get inflation, right? That's the consequence of it. But if you reduce it too quickly, it's almost like we are on a one-way street. You can't actually click reverse on this. You are on a one-way street, right? It's very hard to unwind these kind of positions. They are very, very difficult to unwind these kind of positions. So if they move it to $6 trillion, I think it's going to be nuts, okay? Now let's look at it realistically. If you look at historical as a guide, they moved 4.5 trillion to 3.7 trillion, and they already slowed down the economy. And this was done over almost a period of 2 years, right? So that's only if you look at it, $800 billion, right, over a period of 2 years, right, and it really put global economy in, to slow down quite dramatically over a period of 2 years. Are very, very slow. So you can see the curve here is actually, the curve downwards is actually very, very gentle slope only, very gentle. All right. Can you imagine that? So if we follow the same kind of slope and say they bring it down to 1 trillion, so we will probably be at about 7.9 trillion, right? Which is still double, more than double where we started with before the pandemic. So yes, they are stuck, right? Absolutely right, Yontong, you're right. They are stuck. So they can't bring it down to 6 trillion that quickly because everything will explode. But even if they bring it down very slowly over 6 trillion, you're looking at maybe 4 years, 5 years, right? And then you will see an appreciating US dollar, which I don't think that's going to happen. One of the main reasons that I think it's unlikely to happen is that, you see, the US goes into elections every 4 or 5 years, right? They choose a new president. And whenever, I think it's quite a known fact, especially when you go into the elections, right? You must have that feel-good factor. So not only must you have the political will to do this, right? That means you must have very strong strong support, right? Otherwise, it's very hard to continue on this trajectory, right? To bring it down, it's going to be quite hard. So they also cannot increase interest rates too quickly because it will destroy any sort of recovery, right? So really, the worst case scenario here is inflation, right? Now, so let's say even if they bring it down to $7 trillion over a period of 2 years, if you look at the number of amount of liquidity in the market today, it is still plenty, right? In a very short period of time. Now, so I'll give you guys another kind of longer term graph, right? So if you look at the red line on the bottom, that's inflation rate. If you look at the black line, that is the rate of growth, right, of M2 supply. So you can see in 2020, you see a huge spike, 2021, right? It's never ever gone to that kind of increase before, ever, right? Now, even if you see it come down on the next line, the black line, and drop to 10%, the growth rate is still 10% over the growth rate of 20 or 25% the year before. Now you can see now that we are seeing that inflation rate start moving up because it's a lagging indicator, right? And almost all the time, if you look at this graph historically, anytime it's actually gone, they create a lot of money, inflation rate goes up, then it comes back down again. You print a lot of money, inflation rate goes up, then it comes back down again. Now, so remember, we are talking about inflation rate, not inflation. There's a big difference, okay? So because the media only looks at inflation rate, which means if we maintain prices generally as where they are today, let's say we fast forward, we're now March 2023. And they say, oh, inflation rate now 2%. Oh, so everyone's very happy. Okay, let's go about business. But they forget that inflation rate went up 8.5% versus the year before. So it's rate, remember. So that means almost for this whole year, we are almost quite guaranteed. You're gonna see constant inflation rate going up if you compare to last year. But I think on month to month, you're actually gonna see it start slowing down, right? Now, one of the main reasons, now remember, inflation, the moment it goes up and then it maintains stagnant, that means there is low inflation rate. It doesn't mean there was no inflation. Inflation already happened, right? Yeah, Section, I think it's a good question here. I really don't think there will be some headwinds. There will definitely be some effect. But yes, I will talk about the supply side in a while, right? I really don't think that there is enough firepower from rate hike and tapering to actually curb the inflation on the supply side. I agree with you. Yeah. Let me explain why, right? So the baseline of why, almost the base of inflation is really commodities, right? If you look at the food we eat, you look at how they measure inflation. It's really very commodity based, right? It's wheat, it's rice, it's sugar, right? It's cement, right? It is iron to build your houses, because housing is also part of the CPI, right? It is financial services, that one not so related, but most of the bulk of it, which is energy as well, it's all commodity as well, right? So if you look at this, commodities obviously has shot through the roof since COVID happened. 2021, we really started seeing some movement, right? And what we're seeing today is we're seeing commodity prices are still stubbornly high, right? Now, of course, we talked about this last year. We called it the commodity super cycle. One of the things that we did cover was actually, we covered plantation companies. We invited some CEOs to come in as well. And we're seeing, CPO prices now 3 times where they are today, right? Now, so if you look at historically, if you look at base metal, so we look at base metal as building blocks, right? Very much part of our day-to-day activities. You're going to realize that last bull run that actually happened was between 2001 to 2004, right? That period of time. And then it came back down and actually remained flat for a long time. Since 2005, 2006, we don't talk about oil, because oil works slightly differently. But if we talk about base metals, base metals, if you look at it after the peak and that crash that happened in 2007, 2008, generally metal or base metal prices actually really have not actually recovered. Now, except now we're seeing in 2021 here, right? On the right hand side, what you're seeing, right? Now, similarly, if you look at this, the last kind of commodity super cycle that really went up was really about the same period as well. These were all edible oils or vegetable oils, right? And now we're actually seeing them move to much higher prices, right? Now, so there are a couple of factors that has affected inflation, right? Now, of course, we spoke about creation of money, easy creation of money in a very short period of time. That's only one of the issues, right? The second issue is this here. If you look at the last 10, 15 years, you're going to see that most of the capital investment was actually diverted into the new economy or into the new economy. And really, everyone's really into the whole digital space, right? So a lot of capital was actually attracted there. So when you look at traditional economies, you can see it's been very much lagging the capital investment needed, right? To actually maintain supply or to increase supply even, right? So I've got a couple of slides to kind of share with you guys. So that's the second factor. So one is creation of money. This one is really under investment over the last 15 years, right? The third thing that underlies inflation today is actually when we talk about commodities as the base of cost of inflation, is actually the lag time, right? So if I talk about lag time, I just want to give you guys some ideas, right? If we talk about palm oil, for example, you must have invested in palm oil 4 or 5 years ago and planted a tree for it to bear fruits today for production, right? Similarly, if you found iron ore 10 years ago, it's probably just about getting the production today, right? Of course, depending what kind of commodity, if you're talking about soybean, you're still looking at least 1 year or 2 years at least, right? So the thing about commodities is this: in the short term, it's very, very difficult to increase supply overnight unless there's a technological change like oil and gas, what they did with shale oil, all right? But generally, most of the traditional, when you talk about base metals, copper, nickel, right, iron, we talk about edible oils, right? Actually, there is a lag time production. These are physical limitations, right? So that's really the third factor. So the first factor is really creation of money in a very short period of time. The second thing that's keeping commodity prices high is the lack of investment into production or more production over the last 15 years, because there's not been a reason for it to attract capital. There's not been a reason, right? The reason really is that it's so boring, right? I want to go into something tech, create an app, it's multiplier, everyone's kind of to that direction, right? And the third time is that now the demand has increased over supply. It's very, very hard for this whole supply chain to react in such a short period of time, especially when there was underinvestment in the last 15 years. All right, and if you look at what has exacerbated or made it worse, right? Of course, is the Ukraine and the Russian conflict today, right? And you can almost see like every time there is a war or some sort of war, you will always see a rise in oil prices, right? In this case, Russia being a major oil producing nation and gas producing nation, obviously, and with all these sanctions, it has also increased that as well. And when we talk about even basics like wheat, I think we've all seen it or heard about it. If you look at this, Russia and Ukraine are very large producers of wheat. Of course, EU is the whole block, and in China as well. But if you look at them in terms of exporters, Russia is the largest. Ukraine is number 5. So again, here we're getting a supply squeeze. So Sek Cheng, what you said earlier, you're right? Will interest rates actually change any of these physical dynamics? I don't think so, not in the short term, right? So really, the 4 main issues that we're going to be facing here today, that it's almost I'm going to I'm flowing into the base of why inflation happens, right? I think it's very difficult for some of these commodity prices to have downward push. So QE is one factor that it's going to push, try and keep commodity prices down. But 2, 3, and 4, 2 and 3 actually need time to sort themselves out. 4 will also be sorted, I believe, eventually, but this will take time. So typically, when you are, I'm going to go back again. When your super cycle is very largely based around one reason, right? I give an example. I don't know if anyone can remember. What do you think was the largest cause of rise in iron ore, coal prices, commodity prices in 2002, 2003, 2004? Can anyone guess what was the biggest cause? What was the biggest cause of this? Why did prices slump right after? Anyone want to take a wild guess? There was only really one major factor. Some of you who put it in, you might be right. Actually, the major factor that drove these commodity prices up during this period of time was actually China, right? China was, their economic policy was to build infrastructure. That's why you see a lot of documentaries about ghost cities in China and so on and so forth. Really, that was their big push. Now, of course, when they changed their policies to be more consumer-centric, then you see the demand for a lot of these infrastructure builds actually comes down, right? But now we have commodity prices which have 4 legs. There's 4 legs, these 4 legs here. So the only one that the US is actually talking about right now is actually number 1. Right, they can only fix number 1. 2 and 3 is very, very hard. 3, I think, is almost unfixable. Right, 2 and 3 are quite timed together. I think 4 depends how long these human beings want to continue fighting, right? Because they can end it tomorrow, but that is still a question mark, right? Okay. Look, I think I think there are some questions about stagflation, or Sek Cheng is asking, will it be? Look, I think it will be very, very silly of the Federal Reserve Chairman to increase rates so quickly and to reduce liquidity so quickly to push us into a recession, right? Now, we understand the situation. We are in a rock and a hard place, right? Even one of the largest hedge fund managers, Paul Tudor Jones, said that if he was the chairman of the Federal Reserve today, he would resign. That's what he said, right? Paul Tudor Jones said, I'm going to resign because Jerome Powell has an extremely difficult job. You don't control inflation, we're going to be in trouble. You control inflation, you're going to push your economy into a recession, right? I think if he had to choose between them, I don't think it would be a recession model because it's very counterproductive, right? Absolutely counterproductive. Then they should not have at all even printed money during COVID era and just let the economy go into major full-scale recession, right? I don't think so, right? Because we're now just on a recovery path. Remember 2020, every country in the world posted negative growth except for China, right? But I think it would be very counterproductive to push it so much. Now, how I think that they're going to play it, and I think we're actually seeing some of that, they're going to keep giving signals to the market. They're going to increase interest rate, they're going to increase interest rates, and they're going to reduce bond buying, right? Now, they're saying, right? The question is, maybe at that point in time, they might not do, right? But it's enough to trigger people to soften some of these prices. That's why you can see markets are declining, right? Because people are moving money out. They're drying up the liquidity. So they're getting free market forces to react, okay? Rather than they increase it so that you will push it down, right? And push it into recession. I think that's probably likely what is going to happen, right? I think so. Because, it doesn't make sense, right? Why would I cut off my nose? You heard the saying, I cut off my nose to spite my face, right? And this is quite critical. You see, look, the US policymakers only care about themselves, right? But if you understand that the US dollar, 70% of the US dollar is actually used outside of the US, right? Which means actually US largest export in the last 2 years, is actually inflation. That's their largest export product, inflating. They've been inflating the whole world. They've been exporting inflation to the whole world, right? So really, if you kind of think through that whole process, what they do now is going to be critical to global markets, really global markets, right? Because you have to remember, I know some articles are writing about 1980s, where Paul Volcker actually increased interest rate to 20%. I think that's the fear that we're seeing right now, okay? But you have to remember in the 80s, early 80s, or end of the 70s, it was the end of the Vietnam War, end of the Bretton Woods system, right? So we were in a much less globalized world. So when US increased interest 20%, here in Malaysia and all, we almost didn't feel it, right? Back in 1997, when we had the financial crisis, right, the US had no feeling, right? No feeling there. Their GDP increased even, right? But I think times are very, very different now. We live in a very highly globalized world, right? Of course, the US dollar is still dominant, which I think this is where some friction is happening between China, Russia now, and all the other countries that are less dominant than the US dollar, right? So I think a lot of what they say, people are paying a lot of attention. But yes, likely that we will be maybe seeing much softer prices in the equity markets. But you got to give the market some time. After they adjust and absorb this news, then prices will go back to where they should be, right? Now, by right, even if you ask me, even if they reduce it by $1 trillion and increase interest rates, don't just read the headlines. I think it's too presumptuous to just read the headlines, right? If you look at this, I give you guys some very simple maths, right? They increase interest rate to, let's say, 1%, inflation 8.5%. Inflation rate is still 7.5%, right? But remember, they were counting during COVID and inflation rate now. So if you look at the interest rates here, right? Remember I told you about 1980s Paul Volcker. How much can they really increase interest rates? If you look at it, it's actually a downtrend. I really don't think 20% is possible now, because don't forget, last time in the 80s, we just got off the Bretton Woods system. So the US was still trying to buy credibility that their fiat money was worth something. So they increased interest rate to 20%, right? Now we are 50 years into the Bretton Woods system, right? More than 50 years in the Bretton Woods system. It's very much established, that fiat currency is the norm right now. So if you look at every high, right? I mean, we're not even touching a base here, right? We are like 1.5%, right? That is a little small blip if you look at the screen to where we are. So if you look at some of the peaks, right? Generally, we are still in a fairly low interest rate environment. Sek Cheng, thank you. Actually, I didn't catch Kathy Wood's podcast. I should, but I'm glad we had the same view. So So I think okay, Noriman, I'll talk a little bit about the petrodollar and the ruble in a while, right? Maybe if you can give me a little bit more meat into why you're talking about petrodollar and ruble, right? So if you look at interest rates, look, it's quite insignificant, 0.5 lah. Come on, you're at zero, right? And you go to 0.5. Yeah, when your base is small, right? You know, when you read these headlines, it's crazy, right? But you need to really look at the whole context here. And I hope this webinar actually gives you the idea of the whole context here, right? And how you should be positioning your investments. So I think one of the main beneficiaries that we might still see in the next couple of years, if you want to hedge your stock investments, one of the hedging is really you must look at commodities as the guys that produce it are the guys that really going to really benefit when commodity prices are high today, right? In fact, a lot of the inflation profits are actually going to them, right? By them not doing anything special, it was the same tree last year, but this tree give me more profit this year, right? They didn't do anything special, right? Really QE, supply chain disruptions, and so on and so forth, right? So if you look at the producers, so maybe just a very quick summary, right? So the guys who, if you're a saver, you're going to be a loser. If you're a fixed wage, that's why they're trying to increase minimum wage. Borrows on variable rates are possible losers, right? But let's look at some of the winners, right? So some of the winners are those who have maybe locked into sukuk bonds or bonds which are fixed rate. Okay. You know, if you have physical assets with this inflation, actually you should do better. Remember, it's a lagging indicator. Just because we're at 2.2% doesn't mean we're going to stay at 2.2%. Okay, we actually just haven't seen that hike here in Malaysia yet. But if you follow the global market, likely we're going to see asset prices increase, right? For example, real estate, right? We're definitely going to see that. Commodities, we're seeing some increase, but not majorly. Since we covered it last year, some of the stocks that we have covered, two of them have gone up, doubled, has returned 100%. I think the worst is actually giving you a 25%, but it's much better than technology where it's negative 25, 35%. All right. I think banks will still do well in this space, and of course, one of them is actually Reits as well. So you know what we've done here at Equity Tracker is pulled out all the research. So these are all the upstream guys, right? So if you're interested in investing in the SGX market, these are all your upstream guys right now, right? Rex International, RH Petrogas, Fortress Minerals, who does iron ore, MSC and Straits Trading are somewhat they're related, right? But they're upstream, and of course Southern Alliance as well, right? So these companies are fairly easy to analyze because very much you look at commodity price, you look at the output, and you can already guesstimate what their profit's going to be, because a lot of times the cost of production doesn't change very, very much, right? Even now they say minimum wage go up to 1,005. You know, it's still a very, very marginal increase versus the top line increase in some of these top end producers. Second one is actually banks, right? No, so when actually Chris did this research and we looked at it, it was amazing, right? So if you look at Singapore banks today, UOB being the dark blue, OCBC being the red, and DBS being the blue, right? We almost can see a positive correlation when banks increase the interest rate. So every time they increase the yellow line, they increase the interest rate, you notice their profits also go up. All three of the banks go up as well. When it comes down, it also comes down. It goes up as well. When interest rates go back up, their profits go up as well. So it's quite an interesting correlation. We're seeing this since year 2000. So it's a 22-year chart here. And actually right now, it is to be expected that interest rates will go up. In fact, just on Monday, the banks have actually increased their interest rates in Singapore, right? So you can actually also see this another correlation. You can see DBS, OCBC, and UOB as well. So every time the overnight policy rate or interest rates go up, you see they are still higher. Now, what is interesting that even if interest rates come down, they're still higher than where they were, 2 years before that, right? So because of QE creation, a lot of liquidity, right? The banks actually just captured that margin there, right? So the traditional banks are still, if you look at some of this correlation, are still fairly bankable, right? And here's the interesting thing, right? When we look at Singapore, banks. One of the interesting thing here is this, right? Their CASA or CASA, or known as current account savings account, which really cost them no money, or they even make some profit on them, because these are almost zero interest bearing deposits that they get at lend out. You can see like DBS has got huge CASA deposits, right? So which means their base cost is actually fairly low, right? So the higher the CASA percentage over total deposits actually means that their cost of income is actually lending is actually fairly low, right? So that's actually quite an interesting. So these are kind of the notable mentions that I think will do well as well. In fact, tomorrow I'm doing a session with iFast as well. We're going to talk about Reits. I think Reits is also going to be one of the beneficiaries, because when we see, because REIT is almost like a bond, right? A fixed income. So right now we are seeing a lot of all the prices are coming down, right? Generally, globally, all equity prices are coming down, which means the yields are going up, right? So yields of these REITs are going up. Now, interestingly, about 75% of these REITs actually their debt is actually interest rate fixed. So the yields are not that impacted, right? When we look at it, and of course we're on a recovery path. So when you look at some of the hospitality REITs, or you look at some of the maybe I'm a bit more neutral on office, but I think hospitality REITs and the retail REITs, I think we're likely going to see a rebound with the economy reopening again, right? In fact, Heathrow Airport today just increased their expected number of passengers to fly through the airport by 16% this year, right? So I think there's still quite a fair bit of recovery stocks that actually really have not moved during this period of time. And if you really look at it, the investor psyche is actually quite interesting, right? In 2020, everyone stuck at home, everyone started, speculating on stocks. And I think 2 years later, those guys who did go into gloves or whatever and really got burned, I think very few are still left in the market. So some of you here are the last Mohicans, right? They are still in the market, right? And I think those of you who are still in here during this period, I think this is where you will reap those rewards going further, right? So I think we are we're not contrarian for the sake of being contrarian. I think that's very important. But we must look at the data and the facts to actually guide you to make some of these decisions, right? Now, before I continue to answer some of these questions that you guys have posted, thank you very much for being here. What I want to get you guys to do is that, look, I think SGX gives us a different flavor from Bursa. And one of the apps that I do use is actually on Telegram. So if you guys check out SGX Invest Telegram, it's free. Just go and join the group, right? They actually do their own research and they actually share some of these stats, which are actually quite interesting, right? So I strongly suggest, if you guys can, right, we'll post it in the 2 links here. Check out some of these. Check out the Telegram, right? Just click and it's absolutely free. The other one here is this, right? If you guys are looking for stocks in SGA, you need some information, right? Where would you go to, right? Now, we've actually created a very simple website for all of you guys to use, absolutely free. If you go to SG for Singapore, short for sg.equitiestracker.com, you will actually get access to a whole bunch of stuff on REITs, on technicals, or even fundamentals as well. All right, so do us a favor, like, subscribe to our page, and make sure you go to some of these links that's going to give you some fairly good information as well, all on your mobile phone. All right. Now I'm going to go back to some of the questions that you guys have. So I'm just going to stop sharing here. I'm going to go back here. Oops, my hair's a little bit messy. All right, so I couldn't see it earlier. All right, so thanks for all the questions. I'm going to see some of the questions that you guys have here. So I think Sekchin and Colin, we've kind of talked about at length. Look, Noriman, I think the petrodollar, it's a very hotly debated item, right? If you're not familiar with the petrodollar, it's really, I think sometime in the 70s, right? The US signed with Saudi Arabia that they will buy oil in US dollars, right? Now, so really, if you look at almost all commodity prices today, it's actually priced in US dollar, right? So of course, they are expecting that normally when the US dollar strengthen, commodity prices come down. Normally, lah, right? Okay. But of course, for the other reasons that we've spoken about, I think now I'm not talking about oil. I'm talking about other commodity prices, right? So I think because of what's happening with US and China and Russia and Ukraine right now, right? I think Russia is absolutely right to actually ask to be paid in rubles instead. Now, why are they doing this? Because half of their foreign reserves are actually frozen by the Western countries. And because inflation is skyrocketing in Russia right now, because of all these sanctions, the economy is doing really, really badly, right? So much so that they've actually increased interest rates to about 20%, almost exactly what US did in the 1980s as well, right? Not the first time. This is the second time they've done this. The last time they did this was in 2015 when oil price crashed, right? 20%. So because they need to artificially create demand for the ruble, right? That means if I'm Europe, I want to buy gas, I need to buy ruble first and give you my euro dollar, or I need to buy gas, I need to exchange my US dollar for ruble. So they're trying to artificially create that, right? And of course, Euro is saying, no, 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 you can't do this, right? But look, it's very much politics. But that was the reason why. And because they shut them off almost all on the SWIFT system, but not all, which is also quite pointless. You switch 90% of the banks off from SWIFT, but you don't shut the 10%, then there's actually really no point, because that means they still have access to the financial world, right? So I think that's how Russia is fighting back. But to be honest, the biggest winner from all this will have to be Bitcoin, right? Because Bitcoin because now why do I need to use traditional banking system or my ruble or my US dollars? I could very much switch to Bitcoin as well, right? Or any sort of cryptocurrency. So I think that's probably an awareness, a bigger awareness now that there is an alternative to Swift, right? Yeah. So Guan Hong, maybe you can give me a little bit more detail about China. What do you mean by China? Oh yeah, we talked about China. Yes, correct. I asked the earlier question, right? Okay, Peter. QE is necessary evil. Okay. Let me just put that in here. QE is a necessary evil. Without QE, economy will stall for quite long. However, over a QE increase, that's it. So you're saying too much quantitative easing is bad, too little is also bad. No, I think it's absolutely right, right? I don't think economists or central bankers in the world actually have a formula that that they will follow, that will tell me if I do this, then this is for sure going to happen to everything, right? I think that is quite unlikely. So in the long term, if you look at in the long term and you look at the graph that I've shown you, I can tell you for very clear, definitive yes, that QE will continue, right? Will it slow down in the short term? Probably slow down, possibly, but say in the next 10 years, QE number of US dollars floating around today is the same as it is in 10 years' time? I don't think so. So really, it's a very good question, because in summary, really, if you look at this, those that are going back into US dollars to earn 1% interest, you have to be absolutely out of your mind, right? Because what is eating you up, which is a very silent tax, is actually the constant creation of even more US dollars, right? So without you knowing, your purchasing power parity is actually dropping. Every day, every night you sleep is dropping, right? And that has always been the biggest narrative for crypto, because we almost have no hedge today, global hedge today, against governments, right? which are out of, it's not in our control. If you think about it, it's not in our control. That, I work very hard for my dollars, but there's another guy next to me that's continuously just printing it and devaluing what I worked, right? So obviously inflation is very much part of it. So in this kind of environment, um, uh, it's actually, you're actually worse off holding cash, right? So if you ask me, inflation is here to stay. They will slow inflation rates down, eventually, for sure, because when you compare last year to this year, it's not going to be a fair measure at all. But I think if we measure next year versus this year, with some of the actions that central bankers have taken, it will bear effect psychologically, right? Therefore, when if you, I want to, we always have to remember we have to take the good and the bad, right? So for markets to come down, markets will also go back up eventually. When markets go up, they also will come back down eventually. I mean, it goes in, unfortunately, a very emotional cycle, sometimes not illogical, right? So I think maybe just to answer that question, right? Thanks for your question, Peter. DT here. Out of inflation topics, any thoughts about Buffett Bitcoin comment? Yeah, Buffett, actually it wasn't Buffett, it was actually Charlie Munger, right? He said it was evil, and look, I mean, if you look at uh, if you look at Buffett's track record or Berkshire Hathaway's track record on technology, I think it's been pretty poor, right? So we have to understand that also Berkshire's model is not to get into startups, right? They are very much a value play, which means that only if there's growth and value, right, then they will go in. But they are very much a low risk taker. That means they take later stages, right? They won't come in at the very early stage. They'll come in at the later stage when there's still growth, right? So I just think it's a different style of investing. But I bet my bottom dollar he is going to be wrong in the next 20 years, right? And I've said this in 2017, right? When Bitcoin was only $1,000, I did mention it, and I think I think in this world that we live in, where we talk about the narrative of creation of money, I don't think it's ever going to stop, simply because it's unpopular thing to do. It's an unpopular thing, which means that most of the world's democracies today are run by popularity. So you kind of figure out, they're gonna keep giving you freebies until, as long as it makes you feel good, right? Yeah. Yeah, Peter, I agree with you. I think in 2017, 2018, we never saw that correlation, or even in 2008, we never really saw that correlation. This really means that Bitcoin has gone mainstream, right? And what we're seeing is that 5-6 years ago, when we looked at crypto, we thought maybe central bankers will adopt it, right, or maybe asset managers. But actually, we were wrong, right? The institutions that are getting in today are actually public institutions, public companies that are buying it. So yes, institutions are still coming in. There is demand. In fact, even DBS Bank, one of the most conservative banks. I mean, they're from Singapore as well, owned by the Singapore government. They already started a custodian service and exchange because their clients want it. So we're seeing more and more institutional players coming into crypto markets, right? So actually, this is good for Bitcoin because it means that the adoption trend is going up, right? All right. Okay. Okay. Wow, this is a long question. QE basically exchanges asset for reserve. Yeah, as exchange, that's exactly what has happened in 2 years, right? I'm not against QE. I think QE is very much part of the equation for a healthy economy. But when you do it over a period of 2 years, when there's very little or low production, you must expect inflation, right? It should not be a surprise. For those of you who have waited a while to trying to figure out what to do in investing already, You know, in 2020, I heard a lot of people say, "Oh yeah, I missed out March 2020," right? I think this year might be your year, maybe a very slow decline. But I guess the question is, if you're an investor, what are you doing now, different from when you did? Because a lot of times, trying to manage the emotions is actually very difficult, right? Um, how long can the Malaysian government subsidy last? Question. I personally, these are my personal views. I think GST will have to come back, and that will give us a big bump in the inflation rate one-off, right? Most likely. Um, Subsidies are never good in the long term, but if you've looked at Malaysian as an economy in terms of policies that we made, we've been fairly well insulated, right? Because we still have a very large uh, um, trade surplus every year, right? Because we export more than we import. It's not the best way for productivity, but it gives us a lot of stability, right? But if you look at as an oil producing nation, then really it's a quid pro quo, right? So they sell it at higher prices and then they subsidize it. It's not the best way, but I think we're trying to move into a middle income economy, right? Which means that you're going to see that they're going to increase minimum wages first, right? And then maybe start free floating some of these prices before they can't just increase price without free floating some of these minimum wages, because our minimum wages have been kept too low for too long. And if you look at Malaysia, um, if you compare our minimum wage to our GDP per capita, um, we are one of the highest, right? Which means that there is a huge disparity between the rich and the have-nots, right? The B40 and the T20, it is a very wide gap. So it's also not healthy to the economy. So I think steps needs to be taken first. So increasing upskilling, increasing minimum wage is very quick, right? Um, Before they can free float some of these subsidies or reduce some of these subsidies, right? I think a lot of these subsidies were reduced over time, pre-pandemic, right? But I think right now, if you increase fuel prices, as we don't forget, we really kind of just opened up May 1st, right? So we're hardly 10 days into it today, right? So I think you need some time, otherwise it will be a massive shock to your recovery. Yeah. Thanks for that question, Daniel. Uh, uh, yeah, I think he still doesn't get it, right? Uh, okay. Yeah. So I agree. No country is perfect. We are caught in an income trap. So yeah. So our what? Oh yeah, April 1st. Thanks, Steve. April 1st, but so I get confused. So we're barely a month in, but I think it was only in May that we were allowed, I guess, no check-ins and no masks, right? Sorry, I can't remember, but yeah. Thanks for correcting me on that. Okay, let's see. Thanks for that, Steve. Okay, let's see. Last question here. Look, I love what you guys are doing. Thank you very much. I think this is a really interesting topic. You know, one of my passions is economics, and you know, I love these questions that are coming through. You know, do join us. Every other Tuesday, I'll be online. We will talk about something interesting as well. Let's see, Peter. So speaking about currency value, value is two-factor trade balance, public debt. Um, um, uh, Look, I think I think if you look at our government debt to GDP, I don't believe it's at 80%. I think you're talking about household debt. Okay, they're two very different things. The thing about government debt, of course, they set a ceiling of 60% before. Now it's gone up to 65%, right? The thing that we do have to manage, and it's still quite internal. I think after 1997, I think we were all quite scared already. All Southeast Asian nations that went through 1997, they're quite scared. They've actually been quite scared to borrow in foreign currency. All right. So a lot of government debt you're going to notice is actually denominated in ringgit. So worst case scenario, they can still print ringgit to pay you ringgit. Okay. So there won't be a debt default status and there won't be a panic globally, right? So if you are talking about private household debt, 70-80%, yes, that is very, very high. I agree. And if you look at most of household debt is actually in real estate, right? The reason why it's so high is because real estate has gone up over time. And during 2012, 2013, 2015 period, banks were actually looking for growth. So everybody was buying 5 houses, 6 houses, right? So there was a massive glut. We're still seeing some of that glut today, right, in some areas around Malaysia, right? That's why they need to push. Minimum wages higher, right? They have to, right? We can't be having fresh grad salary at 2,000 ringgit for the past decade. There is no movement there, right? It's close to impossible. Of course, the much painful thing that we can do is actually reduce all foreign labor. But I don't think Malaysia is ready for it yet, okay? Because when you remove foreign labor, then immediately you don't need to increase your minimum wage. Your minimum wage will go out automatically, right? But I don't think, because we got 4 million foreign workers here today, it is not possible. And even if you look at in the short term, increasing minimum wages, mostly, yes, it'll help Malaysians for sure. But there's a bulk of them that will also go back to the foreign workers as well, right? In terms of remittance. So I think it's a delicate balance. There's no perfect there's no perfect system, right? We did inherit these policies from a few administrations. So I don't think one administration can change it overnight, because it's almost like you're spinning 10 plates. You spin this one a little bit faster, then it's like a domino effect. It might make it worse, right? Yeah, Steve. Yes, the compression loan or something they call it, right, in those days, right? Okay. So it's already 1,005. Of course, the government has said they will continue to increase that. I think that is to force. It's the only way to force, but slowly, over reliance on cheap labor, because we cannot have middle income and still have 4 million foreign workers in Malaysia, right? It's just not possible. It's very, very difficult. All right. Look, I hope you guys enjoyed it. It's been an hour. Thank you very much, all of you guys, for staying on. Don't forget, for those who haven't joined our crypto classes, please, right, come and check us out, right? Go to equitystriker.com/crypto. We have details there. There's one coming up in June, right? So Bitcoin is at 30,000. Great time to really. Now, the reason why, I'm sure you guys say, I know Bitcoin, I can read everything, right? But here's the thing, right? When you don't know why you're investing in something, Simon Sinek always says start with the why, right? So if you start with the why, you know the how. So when you don't know the why, when you get tested, when prices come from 66,000 to 30,000 today, you're going to be absolutely tested for your resolve. And if you don't know your why, this is where you will panic and cut loss, right? So I think make sure you make informed decisions and be educated. Do check us out. We will post a link below. Upcoming crypto class is in June, right? And we also have our stocks, right? Value investing, right? So before you actually invest in your first stock, please, okay, get yourself equipped, right? I know there's a lot of stuff online right now, but there must be a structured way to approach it. Okay, so to talk to us tomorrow, actually, we're having a short session. So for those of you guys who are interested to check out that short session about what we do go through in some of our value investing courses, please check it out. We'll also post in the link below. All right. Okay, let's see here. I've got some questions here. Thank you, Yuan. Great session. Okay. Wow, got so many questions here. Look, I think that's okay. So maybe one last one. I think this is too much to answer tonight, but it's been great, right? I love that you guys are posting questions. I think I think Sri Lanka has a different set of problems. First off, we've not had a civil war in Malaysia for 30 years, right? So if you know about Sri Lanka and really the Tamil Tigers and the effects that they have, I think it is not the same, right? We're very much part of Southeast Asia. So for the last 50 years, we've been relatively peaceful. We're peaceful people, right? We are not Americans. We don't like to go into foreign countries and drop bombs and say that we're nation building. That is not the way we do things. I think Sri Lanka is very much an internal mismanagement. That much, right? We cannot be mismanaged that badly to a point that we are still progressing every year. So I think that is that is maybe one of the big differences here. All right. So Steve, I hope that answers your question. Oops. Okay. Okay, DT, like to have similar session in future? Sure. Okay, I'll keep it up. Make sure you tell your friends, like, comment, Facebook, subscribe to us on YouTube as well. If you like more good content from us, as always, for Equity Tracker. Thank you all of you guys for tuning in. Don't forget SGX Telegram group. Don't forget tomorrow night we have a session. Do sign on. If you're interested in crypto, do send us a text as well. I know I'm bombarding you a lot of things. Okay, but join us. All right. Otherwise, from all of us here at Equity Tracker, thank you very much for tuning in. Good night and goodbye.